As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. Today we have an important returning guest. Rob Kirby of Kirby Analytics is with us. He's going to give us special insights into some unusual action that's going on in the gold markets, as well as some insights from his exposure to information in the derivatives markets. And he's back here with us again on Reluctant Preppers to give us an inside view of what's really going on. Rob, thank you for joining us again here on Reluctant Preppers.
Pleasure to be with you, Donegan.
Now, in our conversation, you've been alerting us to the fact of a recent announcement by Jim Sinclair about the correlation between the amount of gold being imported into the U.S. versus the amount standing for delivery on the COMEX and what that might signify. Could you give us more details to help us understand the significance of that?
Yeah, Donegan. Jim Sinclair wisely pointed this out in a commentary he made today. First, you have to appreciate that in the last 20, 30 years, America has imported virtually zero gold from Switzerland. But suddenly in May, America imported 50 tons, an explosive amount of gold from Switzerland, and which sort of broke the norm for many, many, many years. And Jim Sinclair pointed out that almost to the ounce, the amount of gold that America imported in May is the amount of gold as represented by COMEX contracts that are standing for delivery this month. And he just made that comment or that observation, and I find it very interesting because things in the metals market have been acting a lot different in the last 6 months than they have in the preceding 6 years. And we noticed this in gold, in that gold has made very, very big rally in the first 6 months of this year, for one. But it's even more noticeable in what's going on in the silver market. We know, because it's been documented by other analysts like Steve St. Angelo of the SS Rocco report, that the build-in open interest in the silver on COMEX exchange has reached an all-time high in recent days. And typically in the past, when the open interest has made all-time highs, we typically see some sort of an exhaustive event where you'll get a waterfall event occur in the silver price to flush out the spec longs. It's the commercials who are short, and the commercials typically are recognized as being the big banks. And what we've seen from recent highs in silver open interest is that there's been no liquidation event occurring, even on mini beatdown days when the price drops 30, 40 cents in a day. There's no exhaustive event occurring from the long side. And what's interesting about this is we know that China's been a buyer of physical silver this year, and the reluctance of the longs to capitulate and sell their longs to give the commercial shorts a way out of their losing trades, because silver's up big on the year, which means that the commercial shorts are carrying big losses on their books. That is, of course, assuming they have accounting. And with American banks, you never know if they really are subject to accounting. But that's actually no laughing matter, because there is a provision on the books in America where, in the name of national interests, American publicly traded companies can be excused from accounting. So, I don't say that lightly. Um, and I do specifically take special note that in the most recent round of admissions and charges of rigging the metals markets, where Deutsche Bank is front and center, making admissions and being implicated and stating that others were co-conspirators with them. No American banks have been implicated or named as co-conspirators. And the notion that no American banks are involved in rigging of metals markets when we know it's occurring is a dog that just doesn't hunt, because the rigging of the metals markets, who stands the most to gain from this is the United States of America, the U.S. Treasury, and the U.S. Federal Reserve, and the biggest traders in the metals are American banking institutions, and to think that this is just something that was dreamt up by a ragtag group of foreign bankers is just so preposterous. It's ridiculous. So anyway, what we know is that foreign banks are subject to different regulatory regimes than that of American banks, and the whole complexion of the metals edifice has changed in recent months, because we're not seeing players on the long side capitulate in silver anymore like they used to. And this is a marked change from what we've seen time after time after time over the last 10, 15 years. So, what it means is there are new players on the long side. To me, it screams that there are new players on the long side. And I suspect these players are probably, making an educated guess. One might assume it's either Asiatic or new money that isn't afraid to take on the commercials.
That kind of change in ownership, or the change in hands that are at the front lines of that battle for the price of precious metals, do you see that signaling then a sea change or a tipping point in the basically you'd expect to see a change in the pattern that we've been seeing over the past 5 years, where the unchecked paper shorting of the futures for precious metals have driven the price down, but during this whole time, someone's been accumulating and able to purchase at those suppressed prices. Does that make sense that those people who've been accumulating can be turning around then and having stronger hands now to not capitulate and be subject to that kind of suppression anymore?
My feeling, Dunnigan, is that the players on the long side in both gold and silver have drained the swamp, so to speak, in that they've accumulated so much physical precious metal. The cupboards in the Western world are getting very close to bare, and they have very, very little physical inventory left that they can feed into the marketplace to justify or to validate their completely and utterly fraudulent and false paper price setting. I mean, the fraud of setting the price of real metal through paper proxy markets is only valid as long as you can feed some physical metal into the market to validate the price that you're setting. And it's long been speculated by the likes of GATA and the people who report under the guise of GATA that at some point the price of precious metals would go dramatically higher when Western central banking entities ran out of cash of physical metal that they could feed into the market. And I think we might very, very well be at the threshold of that all occurring right now. So that's what these new developments that I've noticed this year, and others have noticed them too. That's what I feel that it's portending and what it's signaling.
And does that play into, or at least correlate with, that other observation you mentioned that Jim Sinclair had alerted us to in the beginning about this curious alignment of the amount needing to be imported from Switzerland to matching the amount that needs to be standing for delivery on the COMEX?
When you think about it, Dunnigan, to think that some entity within the United States needs to import tons of gold from Switzerland, something that hasn't occurred in decades, when America supposedly has 8,000 plus metric tons of the stuff. We know that they're involved in leasing, so we know that in theory there should be physical gold available either for sale or through lease from a bullion bank in America. I mean, because we know that Goldman Sachs is heavily involved in the gold leasing arena. I mean, goodness, they arranged lease deals with the Bank of Italy so they could invest the proceeds with long-term capital going back into the late 90s. We know that J.P. Morgan is involved in that trade too, as per their business they did on a regular basis with Barrick Gold Corporation with their hedge book, which was all done through the guise of evergreen leases with central banks. So I mean, what it really does is it calls into question. What it calls into question is the fundamental claims made by America that they have this pristine sovereign reserve of gold, which by the way hasn't had a credible audit since the Eisenhower administration. It just calls into question what the heck is really going on when American-centric entities are requiring to import gold from Switzerland. Anyway, it's a big red flag to me.
Absolutely. And you and others who watch the actual money flows and watch the metals flows and inventories are really helpful in guiding us to really see how to read these tea leaves, because we are told the official statistics, and you guys tell us that doesn't hold any water if you're looking at the actual transactions that are happening on the books. It reminded me of you were interviewed not that long ago on the Daily Coin in an interview called "Something We've Never Seen Before in Recorded History," where you were talking about the shocking amount of debt that was written up on the books of some of the already insolvent banks around the 2008 crisis that absolutely made no sense on their own as far as who could be the partner on the other side of that trade. But that's an example of revealing, okay, it's like when you can see a huge shadow and you realize that there's something there that's having to cast that size of a shadow.
And specifically what I was referring to in that interview, Dunnigan, was, and I specifically singled out Morgan Stanley. And what I commented on was that back in 2008, Morgan Stanley was an extremely poor credit, and it was well known in banking circles that the Fed and the Treasury were trying to marry Morgan Stanley off to a stronger financial institution, much the way Lehman was basically absorbed by J.P. Morgan, which was, in my view, was a stealth bailout of J.P. Morgan, and the way that Merrill Lynch was married to Bank of America. They were trying to marry Morgan Stanley to somebody, but they couldn't find a willing dance partner to do so. And as such, Morgan Stanley was a very, very, very poor credit. But lo and behold, when Morgan Stanley was the poorest credit probably in the interbank market, somehow they managed to miraculously strap on $8 trillion worth of credit instruments called swaps, which are a combination of interest rate swaps and FRAs. They strapped on $8 trillion worth of them in a 3-month period. And if you believe that they did that with banks, then you believe in Santa Claus, the Easter Bunny, and Keebler-Elves, because there's just no way that occurred with banks. So then it leads you to the connect the dots logical conclusion of, who did they do that business with? They were basically and arguably an insolvent institution. But there again, that's where the rules of banks in the name of national security get excused from accounting. I think they were insolvent. They didn't have to declare because they were given a pass, and then they were recapitalized via stealth from the U.S. Treasury, with the New York Federal Reserve acting as the broker, executing the trades with them. $8 trillion worth in 3 months. All I can tell you is even today, with Morgan Stanley's stock price probably 3 times higher at least than it was at that period in time, Morgan Stanley probably doesn't have credit lines, reciprocal credit lines, to do $8 trillion worth of anything with anyone in 3 months. It's sort of like kids in a schoolyard saying, I'll bet you my dad, is stronger than your dad, and 2 kids saying, I'll bet you $5 million my dad could beat your dad in an arm wrestle. Like, kids in grade 3 don't have $5 million. And the notion is that, that they could or would have it is preposterous. The notion that Morgan Stanley could do $8 trillion worth of swaps, a goodly portion of the medium-term swaps, these are credit instruments. And I mean, to think that Morgan Stanley did $8 trillion worth of credit instruments when they were arguably insolvent is just a dog that doesn't hunt. Sorry. Didn't happen. I mean, it did happen, but you know who the counterparty is, because there's only one counterparty on the planet that would have the resources and the motivation to do that, and that's the Exchange Stabilization Fund.
In that examination of the Exchange Stabilization Fund's role in this and other market interventions, you were exploring on there just how underhanded but how bizarre and what a large scale. You mentioned the role of the Exchange Stabilization Fund as the true one calling the shots, and the Treasury, not the Fed in that case, because everybody seems to watch. We all watch for what Janet Yellen or whoever the Fed chairman is at the time, what their next announcement is going to be about interest rate direction and that sort of thing. But you were making the point there that that's not keeping your eye on where the commands are coming from.
Yeah, listen, anybody who wants to get a clearer picture on the role of the Exchange Stabilization Fund, go to marketskeptics.com, and in the right-hand column of the homepage of marketskeptics.com, Eric DeCarbonell has put together a 5-part YouTube series outlining the way the ESF, or the Exchange Stabilization Fund, works. And in it, he chronicles how the real decision-making process regarding U.S. monetary policy is really made in the U.S. Treasury, ultimately enforced or enacted by the Exchange Stabilization Fund. And the Exchange Stabilization Fund uses the New York Federal Reserve trading desk as its prime broker to effectively feed their wishes or their orders into the marketplace through their henchmen or their captive commercial banks. And the 5 banks or the 5 institutions that ultimately are chosen by the Fed as the broker of the ESF, those 5 institutions are J.P. Morgan, Citi, B of A, Morgan Stanley, and Goldman Sachs, and those happen to be all the institutions with the $40 to $55 trillion derivatives books. So that's how U.S. monetary policy and the expose that Eric DeCarbonell did on the Exchange Stabilization Fund explains how and why it is that way. And I would implore everybody to go and watch it, and watch the series. It's 5 segments that go 10, 11 minutes long each. And I mean, I've watched it over a dozen times. I learn something new from it every time I watch it. It's so rich in content. And this guy, Eric DeCarbonell, by the way, he knew what he was talking about. His great-grandfather was Frank Vanderlip. Frank Vanderlip was one of the attendees of the Jekyll Island conference where the Federal Reserve Act was written. And the guy is banking in his blood. So anyway, I would recommend anybody and everybody have a listen and draw your own conclusions after you've listened to somebody, and nobody else in the world has ever put together an expose on the Exchange Stabilization Fund like this.
And in that same interview, you were describing your sense from all the analytics, all the observation that you've done, that you believe we are on the verge of a major upset in a change. You mentioned now a change in the way that the precious metals physical markets are behaving and the movement of the metals. But you also mentioned in there your belief, your personal, professional opinion, that we're getting close to the verge where all of this digging ourselves into this derivatives nightmare of unpayable, unwindable derivatives exposure will all somehow come collapsing, and just all these controls, all these mechanisms, all these price fixing and everything will be abandoned. Can you describe more what you see that makes you believe that, or is it just because it's reached such levels that you think it's just unsustainable?
Okay, empirically, I'm seeing things in the paper metals markets that we've never seen, or we haven't seen basically, in 10, 12, 15 years. The reluctance of the longs to capitulate in silver. America importing gold from Switzerland hasn't happened in decades. These are harbingers of sea change to me. This is the way I read this: harbingers of sea change. The other thing, and the real common sense point to make is that the policies that have been being pursued by Western central banking authorities are failing policies. They have fail written all over them. The driving of interest rates to zero and this experiment with negative interest rates on the part of the ECB and the Bank of Japan, these are failed policies. The idea that you can use paper massaging to contain the price of effectively physical precious metal is another failed policy. You see, and one thing I do have belief in, Dunnigan, is a little bit, even among sociopaths, like the people who are in charge of our global financial system, and they are sociopaths, and they are globalists, and these people have contempt for humanity. But I do believe that there's something in the human spirit that when it digs a hole deep enough, and when blue sky looks like a little pinhole above your head, there comes a point where even a sociopath will put his shovel down and stop digging. And I believe that we're now reaching the point where these sociopaths either put their shovels down and stop digging, which means they will stop trying to manipulate prices or hold the prices down, and they will ultimately, because they all, at the end of the day, they all want to win the game more than their competitor, and ultimately the cupboards will either be bare and they'll have no more physical metal to feed into the market. But my guess is before the cupboards are completely bare, they'll turn around and start buying themselves, knowing that the prices are going up.
Do you see that as a way for the actual players that have been doing that manipulation to come out with a huge profit because they started the cascading shorts? It went down through momentum much farther than they alone could have done it, and now they can reap that, close that short position and profit on the long side, or is it too late for that and it's just a matter of just trying to unwind and limit the bloodshed?
My feeling is a lot of what's likely to come is going to be trying to limit bloodshed. But what I can ultimately see happening is the paper exchanges like COMEX, in my view, at some point is going to be so discredited because I do believe that they're going to ultimately have to declare force majeure, and they're going to settle everybody in fiat money. And I do believe that the day that they do this, and settling everybody on the long side with fiat money or fiat book entries, your fiat isn't gonna buy you physical metal because there won't be metal for sale in fiat terms, and when that occurs, also I do believe that all futures markets will be sufficiently discredited that we will ultimately very quickly transit to some sort of a cash and carry / barter model in just about everything that counts. I can see breakdown in supply chains occurring, just-in-time supply chains, and I can see a very, very, very vicious inflationary cycle descending on the Western world, virtually what will seem like to most people, like almost on an overnight basis.
Right. Well, it sounds like you're talking about a seizing up of the credit markets when you talk about people needing to do only barter type. It's basically a real asset for real asset.
Well, the Keynesians will finally get their way. They will achieve what fiat money does by design. All fiat money systems always revert to what their intrinsic value is, which is zero. Money that's created out of thin air with nothing backing it is worth nothing if confidence is lost in the currency. And I can see an event coming very soon where all confidence will be lost in the dollar. And when all confidence is lost in the dollar, people will be getting rid of their dollars as quickly as they can and trying to buy something real. And at the top of the list of what they're going to want to buy is going to be physical precious metal, not a paper promise of it.
Well, that's what a lot of us reluctant preppers have reluctantly been dreading is coming, and trying to make preparations for that to limit the destruction and the impact to our personal and family finances. Do you believe that it's possible to prepare in such a way to come out okay through that, or do you think that the economic wreckage will be so extensive that even those who have set aside some physical precious metals or whatever will basically, they won't have lost all their worth, but there'll be other things that are necessary, like land and food and other things will also retain their value?
Again, I view it as a big poker game. And if you're sitting at the table in a big poker game, do you want to have some chips or do you want to have no chips? I mean, if you have metal and you don't have food, maybe you're short stacked. But would you rather be short stacked at the table, or would you rather have no chips and be told to go home? So my view is, you know what? Have your chips and make sure you're at least in the game, or you can stay in the game. Look, my view of what's coming isn't going to be pleasant for anyone. So, like, anybody who thinks that this is something I wish for and something that I feel happy and glad about, you're completely wrong. And listen, people who are buying food and storing food, I don't think anybody doing that relishes the day when there's no food in the grocery stores, because that means they're going to ultimately likely have to defend what they have. And the prospects of that don't really turn many people on. But, would you rather have no food if supply chains break down and there's no food in the grocery store? I mean, I've had some people say to me, well, if you have food, well, then, people are going to just, they're going to come and shoot you to get your food. Okay, well, then let's not have any food and just die hungry.
Yeah, there's no good, there's really no happy path out of that. It's choosing different types of.
Done again. If you get thrown into the deep end of the pool, do you just give up and sink, or do you tread water? Most people I know want to tread water. They don't want to sink and go to the bottom. So you know what? The whole game is trying to tread water longer than the next guy, I guess. But I mean, I don't want to give up.
It's sobering, and it's serious, and it's real. I mean, that's what the normalcy bias is difficult for a lot of people to overcome, looking around and seeing what appears to be a very busy, economic activity. They see a lot of things being sold, a lot of trains and trucks and things driving around, and thinking, gee, it looks like the stock market's high. We know the argument is that a lot of those have been pumped up. A lot of those things are actually flagging quite a bit, but the data you have shows that behind the scenes things are much, much worse.
Well, it's not behind the scenes. Again, listen, in Europe we have $12 to $13 trillion worth of sovereign government bonds trading at negative yield. think about who has to buy those and who owns those bonds. Who owns those bonds is typically pension funds and insurance companies, because they're mandated by their articles that created them that they have to hold sovereign debt. And I'll just tell you something. Insurance companies as a whole budget somewhere between 5 and 7% return on their fixed income portfolios to make their nut. And we have negative yields. Instead of making 5 or 6% or 5 to 7% in return, they're making no return and losing money. And I'll just tell you something. That is not a sustainable model going forward.
No, it sounds like it's a poison pill.
Of course it's a poison pill, and it will destroy the insurance industry. And I'll tell you something. The global capitalist system cannot operate without insurance. And yet we're on a path where we're guaranteeing the destruction of the insurance industry. So, it's not this is not something that I've created out of thin air and a holy-poly idea. Without insurance, everything seizes up. Everything seizes up. Companies can't operate without insurance. And yet we're on a trajectory where we're going to destroy the insurance companies. So long term, everything's dead. But you know what? Even John Maynard Keynes himself said, with his vaunted fiat money system, said that in the end, it's guaranteed to fail. And when questioned further about it, he said, well, in the long run, we're all dead anyway. Well, unfortunately, us living fools are meeting the long run. The long run is here.
Yeah, and a lot of horrific things have been perpetrated in the name of, well, after all, people are going to die anyway. You can justify almost anything, and usually it has been used by. Let's
correct that, Dunnigan. A sociopath can justify or rationalize that that's okay for that reason.
Right.
Anyway, anybody who sincerely cares about humanity, I don't think they see it quite the same way.
And if we could, before we end on that point, if you could give us one more explanation of why the globalist, what evidence you see that the globalist pressures, because that seems to be a major factor right now in the current U.S. presidential election, is you see just a swell of people who have been in favor of new world orders and global trade agreements and everything like that, swelling up behind one of the U.S. presidential candidates, and behind the other one, what appears to be a populist upswelling of people who'd like to reject and throw that off, similar to the way that happened in the Brexit vote in Britain. But if you could give us your view for declaring that the globalist forces are in fact sociopathic and are actually anti-human.
Well, Dunnigan, all you need to do, in my view, is turn on any mainstream American news outlet like CNN, the Clinton News Network, MSNBC. These people are so in bed with the entrenched establishment. They're so anti-Trump. They are so pro Hillary Clinton, which by any definition, at least in my view, is severely compromised, has committed things that amount to treason, sedition. And yet she is the Democratic nominee for President of the United States. I mean, and it seems to me that there's a groundswell of opposition to her, and it seems to me there's a groundswell of support aligning and rallying behind Trump. I don't believe mainstream establishment polls that say that they're close. I think if you look at the alternative press, you get a much better picture of what is really going on in Main Street America. And I think Main Street America has had quite enough of the Clinton-Bush crime syndicate, and I think they've had their mouths full of it long enough, and they want change. And you're right, it's the rise of nationalism, populism, and that's what it really isn't about Trump. What it really is people know that the establishment has sold them out and has betrayed their trust, and they're sick of it and they want change. Not unlike what Britain's done too.
Any other thoughts around these factors that you see playing out with the shifting seas of precious metals? Sounds like you believe the near-term demise of the manipulations, evidenced by negative interest rates that are poised to destroy the insurance industry and seize up credit markets. Any way you can see us getting through the next, let's just pick a number, 2 years without a major collapse?
I don't believe so, and I think it comes much sooner than that.
Well, Rob, you've got proprietary analysis that you do. If people wanted to find out more about that, where can they find you?
They can find me on the web at kirbyanalytics.com.
And we are just grateful always for you joining us here on Reluctant Preppers to give us your inside view of what's going on. Even though to you it's obvious, it's not obvious to everybody. It's not obvious to a lot of us. So we really appreciate you, laying it out there for us and being here and being in our corner.
My pleasure.